welcome back to Trading 360, our 360 round, all about Instacart. Let's bring in our panel. Seema Shah, VP of Insights at Sensor Tower, and Arun Sundaram, Equity Research Analyst at CFRA Research. Excuse me. Arun, you have a sell rating, and there is a slew of competition in the big box retailers. You mentioned Walmart and Target, third-party delivery services, Uber and DoorDash, online, Amazon, and, you know, in addition to earnings, also the lockup, that expiration terminates on February 15th, folks, and there was some concern that that provides some risk, more supply of Instacart stock, and that needs to have to be digested and level out. Arun, what's on your mind? Tell me about this sell rating. And to keep this sell for some time, what's going on?
Yeah, hey, Nicole, thanks for having me. Yeah, I mean, we do have a sell rating and a $21 target price. Clearly Instacart was a pandemic favorite, but now it's facing much slower growth in this post-pandemic period. I think going into 2024, there's going to be some significant headwinds for Instacart. Number one, food disinflation, lower year-over-year food prices. That should be a major headwind for Instacart. Also, shoppers just cutting back on discretionary purchases. A lot of them are returning back into the store to avoid these fees for online delivery. That will likely be a headwind in 24. We do see increased competition, especially from DoorDash and Uber, who will likely continue to take market share away from Instacart over the next several years. And then longer term, we just see structural challenges for widespread online grocery adoption. Grocery delivery, it is not very profitable for retailers. Instacart is actually pretty profitable, but there are longer term concerns about widespread grocery adoption. For one, there's high service fees. Number two, these are perishable items. Most of the time they're being delivered to the customer's door, and there are just quality concerns about how you deliver perishable items to the customer's door. So we do see more downside risk over the next 12 months, and that's the reason for our sell rating.
Yeah, and I saw when Kroger's Albertsons really completes their merger, they talked about also lower prices. You talked about food disinflation, the prices coming down, and that could be a headwind. Seema Shah, what are you thinking here? Because there's certainly a big competitive landscape. Customer behavior, right. Will they be spending? Right. Your thoughts?
Yeah, so our data is a little bit different. So we can look at our monthly active users that correlate directionally very much in line with Instacart's orders and GTV. So based on our data, it looks like there will be an uptick in Q4, and in 2024 year quarter to date, we are continuing to see an acceleration in our MAU growth, which suggests an increase in orders and subsequently GTV. But I would agree with Arun, yes, like most of their growth in GTV will be coming from orders versus average order value because of disinflation. But I think from our perspective versus the direct competitors of Gorillas or Get Here, they're performing significantly better, particularly in the US, in terms of growing their monthly active users, getting users to come back to the platform. And versus DoorDash and Uber Eats, they're significantly smaller still, and that is a competitive threat for them. But they're being competitive, at least based on our data and the way that their MAUs are growing.
Yeah, well, that's some good news there. I mean, you've seen gross transaction volume. You had good news there. Tell me more, Arun, about what Instacart needs to do. Do they need to do something differently?
I think one thing that they do have going for them is that their business model is it's much different than DoorDash and Uber Eats. Because grocery delivery is typically large orders, the economics behind it is typically better than, say, when you order Uber Eats and you get a delivery from a restaurant. It's a really small order, typically like $10, $15, versus a grocery order is typically somewhere north of like $70, $80. And because of that, the economics behind Instacart's model is typically better than DoorDash and Uber, which is why Instacart's margins are actually much higher than DoorDash and Uber. EBITDA margins for Instacart is about 20%. Right now versus Uber and DoorDash, it's in the high teens. So they are much more profitable. We just don't think that that's sustainable over a longer term. Like I said before, grocery retailers are laser focused on lowering costs. And I think one way they'll do so is try to fight back against some of these fees for online grocery fulfillment. And I think that will, eat into margins over the longer term.
Yeah, and Seema, look, we know people are buying something. Coca-Cola saw its stock gaining after the top forecasts prices and volume rose. What does Instacart need to do to differentiate itself?
I think one thing that they're doing, and which will be a higher margin business, is to continue to grow their advertising, which they've talked about. It's about 30% of revenue right now. And based on our digital advertising data, they're one of the largest advertisers of alcohol because they're a distributor, not a retailer. So they're allowed to do that, whereas the retailers are not allowed to advertise alcohol in many cases on their platform. So I think that's in their favor. In terms of fintech, they have Klarna, who is not advertising anywhere else. So I think as they continue to grow the advertising business, that's one way to potentially offset the risk from the structural changes that Arun mentioned and just general competition.
Yeah. I see the list of Super Bowl ads. It came up when I pulled up Instacart, so I guess they must have had a Super Bowl ad that I didn't see. But thank you both so very much, because we know this IPO, and this has gone basically, from the 40s down to these lower levels. Maple Bear, Instacart, CART. Thank you both. Arun Sundaram and Seema Shah, thank you.